for Stock Market 101. It's also get an update on the stock market. Martha Vincent joins us live from the Ayala trading floor. Good morning, Martha.
Good morning. I heard you say good morning, Ron. Anyway, good morning, Ron. It's a Friday. I think I'm, wanting to have my weekend already, but it's 9:46, and in the last couple of minutes, we've been seeing the market accelerate its gains. Right now, the PSE index is at 4326, up by about 0.8% or 33 points. All major gauges, of course, in the U.S. Gained almost or more than 1%, to be exact, 1.3% to 1.7%. The Dow Industrials in particular surged almost 200 points or 1.66% as major central banks make sure that Eurozone institutions have easy access to borrow dollars. And so that particular news is also being cheered here in the Asian region. All Asian markets that are open for trading at this time are also trading in positive territory. And as mentioned, the PSE index is among those, up by about 0.8%. Now all sub-indices likewise trading in positive territory, and we're seeing the holdings, property, and mining and oil sectors also posting gains of over 1% at this time. The mining and oil sector in particular is up by 1.5%. There are 62 advancers, 10 decliners, while 22 issues are unchanged at the moment. Value turnover stands at 498 million pesos. And as you mentioned, Ron, it's Friday, and it's time for our Stock Market 101 segment. And today we'll be talking about basic stock valuation tools. And for that, we're joined by Mr. Jay Peñaflor. He's Assistant Head of the Market Education Department of the Philippine Stock Exchange. Good morning, Jay. Always a pleasure to have you here.
Good morning, Ta.
First of all, let's jump right into what we're supposed to be talking about, the stock valuation tools.
Yeah.
The first on your list being earnings per share.
Okay. Well, earnings per share that simply tells you, or is a measure of a company's profitability. So, well, you would want to invest in a company that is profitable because, well, profitability is positively correlated with the company's, well, cash dividends, and usually profitability is also positively correlated with price performance. So you'd want to invest in a company
that's making money.
Exactly.
Because,
well, there is a positive correlation between cash divs and price performance. You'd want, if you want to make more money, more gains, choose a company that you think is profitable today and will be more profitable in the coming days ahead.
Okay.
And EPS is the best measure for that.
And how do we exactly compute that? We, of course, have a sample there. It's calculated as?
Net income, or a company's total net income for the year, divided by the total number of outstanding shares. And you can get those data, net income, well, from the company's financial statement or annual report, and outstanding shares can be obtained from the PSE website, or maybe from the company itself, its annual report.
Okay. And for example, we have there a company that has posted a net income of, say, 1 million, let's say, pesos, and their number of outstanding shares is also 1 million.
Yeah.
So then its EPS is
1. So that's basically 1M divided by 1M.
So you get 1. So the EPS is
So 1 is interpreted as, well, you expect 1 peso earning per share, or the investor expects to earn 1 peso for every share of stock that he has.
Okay, so it's as simple as that.
Yeah, and EPS is sometimes used, or can be used to measure a company's future cash dividend. But of course, you need to consider some other factors as well. So I think we'll talk about those later.
Okay, and the dividend payout ratio, that's next on your list.
Yeah. Well, that's simply the portion of a company's earnings per share, which will be declared as actual dividends. So you can get that by dividing actual dividends per share, or the total actual cash that the company declared, divided by the company's earnings per share times 100.
Okay. So for example, you have there a calculation of the actual dividends being 75 centavos, and then the company's EPS is, for example, pegged at 1 peso, and you multiply that by 100. So the resulting value would be 50%.
50%. Let's use a good example, Martha. Last year, a telco, a big telco company's EPS was 212.
Okay.
So its trailing earnings per share was 212. So, but this year, that specific telco company has already declared around 222 in actual cash dividends. So 212 divided by 222, so I think that's over 100% dividend payout ratio, which makes that telco company a very good investment in terms of cash dividend or in terms of payout ratio.
Okay.
Well, the comfort zone is that a company should have a DPR or payout ratio, which is 75% of its actual EPS, or 75% DPR or payout ratio. So that makes a company.
So that's your gauge. If it pays out at least 75% in terms of its payout ratio, then it means that they're not stingy. They're willing to share a lot of their, not exactly excess cash, but in terms of their dividend policy, they really are very generous to their investors. And of course, we would just like to bring a past learning here in our stock market segment, which you would say that, of course, one of the ways by which investors could earn from the from equities is not just through capital gains, but through dividends, of course.
But you also need to consider a company's historical cash div declaration, historical dividend payout ratio, and you also need to be able to compare this with other companies so that you can choose a better investment.
Okay.
And, also consider a company's future expansion programs or projected earnings and some other factors. Those are the things that you need to consider in choosing a good investment.
Okay, moving on, you have the cash dividend yield.
Yeah. Well, if you want to compare your actual yield against other investment instruments, or maybe if you want to compare your actual yield against the country's current inflation rate, then I think the best measure would have to be dividend yield, which can be obtained using the data formula, which is I think being shown on TV now on your TV screens. So actual cash dividends divided by the current market price of the company times 100. You can also use your actual acquisition cost. If you want to get hold of your actual yield. So if you want to compare your cash dividend yield against, let's say for example, your time or savings deposit yield, or maybe your yield from your bond investments, then you have to compute DY, or the dividend yield per share.
And given your example here that you have a dividend yield of about 20%, then that means
20%. Compare that with other investment instruments. Time
that perhaps gives you what 1 to 3%.
Correct.
Okay, and the next one being price to earnings ratio.
The PE simply looks at the relationship between the stock price and the company's earnings. PE ratio, Martha, is one of the most popular stock market metrics or stock market ratios that investors use.
And why is it popular among analysts and investors alike?
It basically tells you if a specific company is still undervalued or cheap, or if a specific company is already overpriced or overvalued. So that's a PE ratio.
And how do we find that out?
Simply by dividing stock price and EPS.
Okay.
So stock price divided by earnings per share will give you a number which we call PE or PER.
And what does it tell you? For example, in this instance, you have a PER of 5. Yes.
So, 5. It simply means that investors or a specific investor is willing to spend 5 pesos for every 1 peso of earnings or 1 peso earning of a specific company.
Okay.
And
When do
yeah.
we say, because you mentioned earlier that it's a good gauge to say whether a company is already overvalued or undervalued. So
Yeah.
when can we say that it is undervalued?
Well, we need to use three basic determinants. First, PER should be 15 times and below. But well, when choosing between two company, compare their EPRs or their respective EPRs. The company with a lower PER is usually a cheaper investment.
Okay, and
or investment.
Uh-huh.
Yeah.
Just to give an example, we got some of the PEs of the companies of banking issues,
Yeah.
and this came from the website of the PSE. And then just to cite, for example, BDO's PE is at 16.7 times, BPI's is at 17 times, while, for example, Security Bank is at almost 5.3 times,
Yeah.
and RCB at 8.3 times. So obviously RCB and Security Bank, both are their P is both below 15 times.
Okay, but well, like I said, you also need to consider some other factors. Well, you have to take a look at the company's future profitability, expansion program. But well, if you use PER as a basis, then the company with the lowest or a lower PER is a cheaper investment. But you also need to compare the company's PER against the PER of the industry as a whole.
Okay.
And you would also need to take a look at the PER of the PSEI, which I think is around 15 times at
as
the
well.
moment. And you also need to compare the company's PER against the PER of the stock market as a whole, which I think is around 18 to 19 times. So your company's PER should be lower than the competitor, than the index or the industry PER and the stock market as a whole. Then well, you can arrive at a conclusion that the company is cheap in terms of PER. But again, you need to consider some other factors as well, because it doesn't aim to predict consistently and accurately a company's future price movement. But
Right.
you can use PER to it aims to reduce well, risks and will help you arrive or make a sensible investment decision.
Okay. And from that, we move to projected earnings growth.
Well, PER or PE ratio is limited. It deals with the company's future, I mean present earnings only. It forgets about the company's future earnings. So if you want to measure a company's future earnings compared to its current stock price, then the best or the better measure is the company's projected earnings growth, or PEG, which is calculated by dividing PER over the company's future earnings. But the question is, where should I get a company's future earnings? Well, you can get that from the company or maybe from your stockbroker. They have some forecasts or maybe projections of a specific company's future earnings.
So then that's what you'll use as a the lower part of the divisor for that particular formula.
Yes.
Okay.
So PER over earnings growth, and then you'll get a number.
So for example, in what we have here, the resulting number would be 2.
Yes.
And the interpretation being,
Yeah. Well,
We're having a connection problem. We'll try to get back to Martha later on. Meantime, here's Ginger.